Thanks, Nah. Hey, everybody. Good evening.
Ostie, what's up, man?
Hey, Nick, how you doing?
Doing pretty good, man. You having a good day?
Yeah, so far it's been good. You just got back from a lot of traveling, so it's nice to be home.
Yeah, I gotta reset, man. Gotta
That's
reset.
right, dude. This is a good way to do it too. This is a good way to do it.
Do you actually find this like relaxing?
Yes, I think
Yeah.
it's fun. I mean, it's when it's something that I feel like we're all passionate about, it's a good time, dude. It's not like a day job to me or yeah, it's not. It feels it's something I look forward to.
That's awesome, man. That's awesome. How long you been trading for?
Since June of 2020 seriously, but I've been kind of following markets since about 2018. So actively trading a little over 5 years.
Dude, that's awesome, man. That's awesome. Well, I'm looking forward to learning more from you, man.
Well, I appreciate you being here, dude. Have you been in some of the previous lectures that we've been doing, or is this your first one tonight?
Nah, yeah, I've been around for a couple weeks now. I originally joined the Discord back in 2020, but then
Okay.
working full time, I couldn't follow the market, so I stepped away for like four years or so. But
And now you're back.
yeah, I've been back for about a month now. I'm loving it, man. It's a great
Well,
place.
welcome back, dude. Welcome back. Yeah, it's a good place to get your feet wet again, and I'm super happy to have you. And thanks for coming out tonight, dude. I hope you enjoy and it's worth your time.
I appreciate you, brother.
All right, we're gonna get started here in just a couple of minutes. We're just gonna give everybody else the opportunity to hop on in. So I apologize for missing last week's lecture. I was kind of optimistically hoping I was gonna be able to do it, but I was in Texas traveling and it didn't work out. I didn't feel like I'd be able to deliver on the quality, and I thought it'd be better to cancel rather than give you something that's half baked. So hopefully you guys understand. And yeah, I'll try to continue to be real with the expectations I set for this course because I want to make sure it's up to a quality that I would expect if I was the one attending. So anyway,
Man,
I'm gonna.
next time you're in Texas, hit me up, man. I'm in DFW area.
Oh, dude, that's exactly where I was at. I was in Grand Prairie.
Yeah, hit me up. We'll go fishing or something.
Where do you live at in that area?
I live in Saginaw, like north of Fort Worth.
Saginaw. Okay, okay. So
So if
how far is
you're
that from Grand Prairie? Is that like an hour?
30 minutes, 45.
Dude, I've been wondering what people do for fun out there, and I figured it had to be fishing, dude. I would definitely be down. I come out there about every 3 months.
Yeah,
Um,
I got a boat. We'll go fishing, and then we'll do some trading afterwards.
Dude, that sounds fun, honestly. Yeah, that sounds real fun. We'll
All
have
right,
to let
bud.
you know.
All right.
All right. Well, it's a couple minutes after the hour. Sorry, let me send this one last message, let everybody know we're getting started, and then we'll get into it. All right. All right, everybody, let's get into it now. Yeah, there's no place like home, Scotty. I agree. This is the Intermediate Course Series Lecture 3. So we're barely a quarter of the way through this one. I'll kind of remind everybody where we're at. We're going to spend a lot of time kind of recapping previous things that we've covered in the lecture series. There's already been a lot. It's only been 2 lectures, but all this is new. Couple things that I want to do just to figure out kind of where everybody's at. How many of you have been to either one of the intermediate course series lectures over the last month or so? Has anybody been to lecture 1 or lecture 2 within the last month? Been to both. Thanks, Avenger. I appreciate that. All right. Great. So a lot of you guys have been to both. Okay, good. Cool. So this should be pretty nice then. He was, but it went mostly over your head. That's okay. I respect the honesty. It's good you're here and you're pushing yourself out of your comfort zone. All right, so I'll just keep the introduction brief then, and as we continue on more of these course series, I assume less and less people will be brand new. Just as a quick introduction, this is our intermediate course series. What's up, Aaron? All these lectures are brand new. I've never delivered any of them before, so there might be some kinks here or there. There might be some things that aren't perfect, timing wise, content wise. I might have made a mistake here or there. But as always, I'm going to do my best to make it as good as possible. One other thing that I like to think of these lectures as is I kind of like to compare them to a college course in the sense that a lot of the lectures begin with content that's a little bit easier. And as we continue throughout the class, we kind of build on top of those ideas. We also are going to recap things from prior lectures, and from time to time, we'll do kind of question and answer quizzes or that sort of thing. So with that in mind, let's just remember where we're at here. So this is a 12 course series. We're on lecture 3 here, indicators and oscillators. And over the last couple of weeks, we've covered advanced chart analysis and market structure, as well as candlesticks. Now, again, as a reminder, we have our beginners course series that I've delivered probably 4 or 5 times now at this point. And this lecture series is not going to be intended for beginners. And not to say that, you're not going to be able to learn something if you're at that beginner level, but I'm going to do my best to kind of stay away from explaining more beginner level concepts and focus on the traders with, 6+ months experience, and hopefully really anybody with that level of experience or more can learn a lot from this course series. So anyway, that's the big idea. We got a lot of lectures still to go. We're barely a quarter of the way through as of tonight. And tonight we're going to talk about indicators and oscillators. And this one, honestly, was a little bit more difficult for me to put together because there's only so much to talk about as it relates to indicators and oscillators. The way I see it, the basic indicators and oscillators lecture is going to cover more on, this is the RSI, this is what a moving average is, that sort of thing. And instead for this lecture, I wanted to focus a little bit more on indicator systems and give you guys some inspiration into combinations of indicators. We're going to stay away from getting too deep into moving average systems, which that's covered in great detail in lecture 8. However, today we're going to focus a lot on other sorts of indicator systems, and I'll give some more clarity as to what that might be as we get into the content a little bit. And as a reminder, we have 2 main goals of this lecture series. First one is going to be to improve the skills of traders who have a baseline understanding of technical analysis and the stock market. So as I mentioned, again, I'm not going to be covering the basics. I'm not going to be talking about, what the close of a candlestick is, how to draw a support level, that sort of thing. We're going to focus on gearing this content towards individuals with a little bit more experience. And again, I still think, if you are at that beginner level, you're more than welcome to stay, and I can almost guarantee you'll still learn a decent amount. And feel free to ask any questions. I'm always happy to clarify or provide extra information. But again, just as a note, it's not going to be super geared towards that group of people. And then finally, and probably the most important goal, is going to be to teach you all how to apply the techniques discussed in this course. because it's great to talk about all these things in theory, right? It's great to talk about, moving average systems or support and resistance or volume price analysis. That's one thing, right? But it's a completely separate exercise to implement these concepts. And that's why I want to continue stressing throughout this course series that it is very important for you all to practice implementing the things that you learn in lecture throughout, the following week or following 2 weeks after you learn them. And maybe it doesn't jive with you. Maybe it's not something that you want to incorporate in your trading. But that's going to be the best way to learn it, right? Is actually trying to do the things that we talk about. So for example, when we talk about market structure and understanding trends, go look at 10 charts and try to better understand the market structure of that name, mark out the higher highs, higher lows, determine the current trend, that sort of thing. Open up a couple charts with some indicator systems that we talk about today and determine, if they're maybe in more bullish or more bearish territory, any kind of positive or negative divergences, that sort of thing. So with that, I wanted to recap the last 2 classes because it has been a while. It's been 2 weeks since our last class on candlesticks. So I wanted to take a little bit of time to just remind everybody on everything that we've covered and where we're at. I'm going to continue to do this and try and incorporate basically everything that we've covered as a recap in the beginning of each lecture. I'm hoping that helps just kind of really reinforce these concepts in everybody's mind. This is going to be a nice indoctrination, and hopefully you guys agree that it's an effective strategy to keep things fresh. So with that, let's talk a little bit about some of the things that we covered in our first lecture. Before we do that, sorry, one more quick reminder. As always, guys, any comments, questions, feel free to put them in the chat. You guys are also all free to unmute your mic at any time. So if you want to ask a question and you feel like I won't shut up, just unmute, start talking, and interrupt me. It's no big deal at all. This is totally an open forum, so feel free to talk whenever you please. Okay, so jumping back to our first lecture in the series, we talked about market structure. And we talked about a couple kind of main important points as part of market structure. First, we said, yeah, that's true, Nick. First, we said that market structure helps us indicate the direction of trend. And what I mean by that is, for example, if we have a sequence of, say, higher highs and higher lows, that would confirm that the trend is up and buyers are in control. And each one of those subsequent higher highs shows that demand is strong enough to overcome previous selling pressure that took place at the prior high. And if you want to take a look at a quick example of that, we have one here that we made in the last lecture or 2 lectures ago, where if we have our initial high here and an initial low here, this is our first lower high and first lower low. Here we can see between these 2 points, selling pressure actually increased, right? Because the next high was below the previous high, indicating that sellers were willing to step into the market earlier than before, which basically means that selling pressure has increased and sellers have become more aggressive. Next, market structure helps us better understand the continuity of trend. And again, to add a little bit more context to this, as long as, say, higher highs and higher lows are maintained or lower highs and lower lows are maintained, the trend would remain intact. And once the structure begins to shift, that begins to signal trend weakening or reversal. And again, same thing for this example, right? We have this first higher low right here in this specific area. This is that first indication that the trend is beginning to weaken, right? And that doesn't mean that we get long the first time we see a higher low, right? That's not the idea. However, it's a kind of a note that we put in our back pocket and we say, all right, maybe things aren't as strong to the downside as they were a couple weeks previously. And here we have that first higher high coming out above this prior lower high, which again is another indication that we've now began reversing the direction of trend, right? So we have a sequential higher low and higher high, which confirms now that the trend has reversed. Now, with anything in the market, we don't have any expectation of how long the reversal will hold for, how far the reversal might go before it turns the other direction once again. But all we can do is react to the current data that we're being shown, which at this point in time right here, we got a subsequent higher low and higher high, indicating a reversal in trend, meaning that this downtrend was no longer the primary direction. Finally, the market structure or the concepts of market structure can be used with trade planning and risk management. And I feel like that can be shown super elegantly by just looking at this chart alone. These levels that we have charted here, 549, 575, and 480, are all very logical stop loss and potential entry levels, right? For example, if we are trading a downtrend, right? So let's say, for example, we're short the market, well, anywhere, right? Doesn't matter where we shorted the market, but let's say we're short, right? If we begin to break back above this 549 level, that should be a sign to us that the market is no longer in a downtrend, which makes it a very logical stop loss, right? Because now a break back above this previous low and previous high now indicates that the trend structure has shifted from a downtrend back into an uptrend. So a couple key points about market structure. I know we blew through it. We've talked about it 3 times now, but any questions, anything that I can remind you guys on before we move on to the recap of the candlesticks lecture? Again, this lecture in specific, I'm spending a bit more time on the recaps just because there's a little less content to cover in the indicators piece. So I want to try to balance that out with a little bit more value on the prior recaps. But it just rings some bells. I know we didn't go through every example, it didn't go through too much content, but hopefully for those of you who are in that first lecture, kind of feel like this is familiar. You've seen some of this stuff before. Yeah, any comments or questions before we keep rolling? All right, cool. Let's keep rolling to a recap of the candlesticks lecture. So this was our lecture that took place about 2 weeks ago now. And again, as I mentioned earlier, this is not going to be a recap of kind of a basics candlesticks lecture. It was a bit more complex in nature, still nothing too crazy, but anyway. All right. So this, and if you guys remember this graphic, when this came up, I basically said, this is the only thing you need to know about candlestick patterns. It doesn't matter if you memorize all the hammers and all the bullish engulfing and harami, star, and whatever other names that people have come up with, all the candlestick patterns. None of those names matter. Don't think that if you memorize all that, you're going to be, some kind of trading champion, because that's absolutely not the case. At the end of the day, trading is a game of tug of war between buyers and sellers. And understanding this graphic alone gives you basically all the knowledge that you need to understand what candlesticks are telling you. So on the left side of this graphic here, we have a representation of what is the strongest bullish candlestick and the strongest bearish candlestick. And in both of these examples, there's a pretty clear similarity. Number one, there's basically no wicks at all. Number two, the candle either opens, or we'll focus on the bullish example, the candle opens at the low and closes at the high. No wicks at all during the period. And as we transition closer to the weakest bars, we get more and more of a wick on both the bottom side of the bar and the top side of the bar. And we notice that the closing price of the bar gets much closer to the open price of the bar. And what this indicates is sellers beginning to step in, right? It's indicating the fact that buyers are less strong than they were previously. If we think about it, right, if we have a bull bar closing near its high, like this example on the left, that is a textbook indication of a strong breakout. And if you go look on a chart and find all these types of bull bars closing near their high, basically every single time you're going to see some amount of follow through to the upside. Now, again, obviously that's not always the case, right? But very commonly, when you see a bull bar like this closing near its high, it basically means that buyers can't get enough of this name, right? They're jumping in super aggressively to buy a given equity or a given stock. Whereas again, on the right side of the graph, we're no longer seeing that same aggression, right? We're now seeing the initial signs of sellers beginning to enter the marketplace in significance, right? The open of that bar is now much closer to the closing price of the bar, indicating that buyers really didn't make any progress during this period. Like, for all intents and purposes, price moved nowhere in this bar. And we have this massive wick to the upside, indicating the presence of a significant amount of sellers. So this really is the one graph that you need to understand all types of candlestick patterns and why they matter. You don't need to know what a hammer is. You don't need to know what a bullish star or shooting star is or any of that. None of that matters. This explains everything that you need to know about candlestick patterns. And that is a hill that I will die on. Couple questions in here. Happy to hear that, Tito. That's awesome. ZT, yep, happy to hear that. This is an excellent graphic. I 100% agree. GA, what do I think the best time interval for candles is? It's an interesting question. In terms of what I think the best time interval for candles is, I'm always looking to the higher time frames. So the daily and weekly time frames are basically my favorite time frames to look at because they represent such a massive amount of data, and candlesticks on those time frames hold a lot of weight. But that's just because the type of trader that I am, and that is just an opinion. Depending on the type of trade that you're taking, the 1 minute time frame might be the most important. If you're a high frequency trader, right, and you're in a trade for under a second or 5 seconds, the 1 minute is what you care about. If you're a longer term swing trader or position trader, the daily and weekly is going to be your Bible. So my opinion on what the best time frame is always going to be daily and weekly, but that's just because of the way that I trade. That's not, and that shouldn't be taken as like a universal best, because in my opinion, there is no real universal best. If you put a gun to my head and said you have to look at one time frame for the rest of your life, I would just say the daily. So I hope that answers your question. Can I explain fair value gaps and how to best identify when one is created? That's a very interesting question, Nick. I'll answer it reasonably quickly because it isn't necessarily part of the scope of this lecture, but I'll answer it. So fair value gaps, it's not a concept that I've personally studied super extensively, so I can't speak on it too directly. But this, for example, let me just clear this chart really quick to make it a little bit better. Oops. One sec. So this bar here would be an example of a fair value gap. And the idea behind fair value gaps is that price moves really quickly through this range with kind of little opportunity for buyers or sellers to get involved. And the idea is that this kind of fair value gap would act as a support or resistance level if it's retested, which you can see kind of happened on this bar here and this bar here. I can't really answer the question super sufficiently, Nick, to be honest with you, because I don't have a great understanding of the theory behind this as to why it matters. I believe this is a fair value gap as well here, I believe. But yeah, I don't 100% know. I think the big idea is a fair value gap. You have to break prior lows, and yeah, like the next bar doesn't retrace the length of the previous bar. So anyway, this is my best kind of attempt at identifying fair value gaps. But again, it's not something that I really am following too carefully all the time. I guess there's one more right here that we'll just highlight and kind of see how we reacted to. So this would potentially be another example of a fair value gap here. Kind of see how we reacted to that one. Yeah, that I know that's not the best answer, Nick. But to be honest with you, I'm not the expert on the concept, so I probably am not the best person to answer it anyway. That's my best shot. All right, cool. So as part of the candlestick lecture that we had 2 weeks ago now, we spent a lot of time talking about a couple key lessons from a really legendary day trader named Al Brooks. If you guys haven't heard of Al Brooks, I highly recommend looking into him a little bit further. He's got a lot of excellent YouTube videos to watch. He is one of the most detail-oriented price action traders. And if you feel confident, go watch his videos. They can be really dry, really boring, but it's just all matter of fact and really, really incredible knowledge, in my opinion. And River will say the same thing if you ever get to talking to him about Al Brooks. So kind of as we alluded to earlier, some people may imply that understanding candlestick patterns is 90% of what is required to learn how to trade. Unfortunately, it is not. A setup is composed of two things, a signal and context. And without both, you shouldn't take a trade. And what we talked about in the prior lecture is 4 different types of a trend, where we have a breakout, a tight bull channel, a broad bull channel, and a trading range. And in general, these trends vary in strength. And the reason that it's so important is if we, for example, have a hammer reversal candle like we do here during a massive breakout, there's still a lot lower of a probability of something like that working in a breakout as opposed to a trading range, right? Because in a breakout, basically every single bar is a buying opportunity, right? If you look at the volume during a breakout, you can see that it is almost always going to be above average. And that's because institutions and traders are looking to buy every single bar of a breakout. So as a result, there's a high probability of upside during a breakout. And as we transition over to the right, as the trend weakens and begins to flatten out towards the trading range, when we're in a trading range, bulls and bears are able to make money pretty easily, right? Because we're in a range. It's a very clearly defined range. And in general, there's a 50-50 chance that the trading range either breaks to the upside or to the downside. And in the trading range environment, a kind of hammer sort of candle or reversal pattern is going to be the best way to make money, right? Buying a reversal off the lows or buying a reversal off the highs is going to be what bulls and bears are looking for to get an optimal entry, right? And conversely, in a breakout, right, if we see a bull bar closing near its high during a breakout, well, typically that's an opportunity for bulls to get long. But if we're in a trading range and we see a bull bar closing near its high, we know in general that that could mean a lot of different things, right? It's not necessarily a good thing. Like for example, here we have a bull bar closing near its high, but we're still below the prior highs and prior level of resistance. So this, maybe bull bar closing near its high or this bullish engulfing isn't such a good entry anymore, like it might seem like if you just looked at a textbook. So the intent of introducing these examples in our prior lecture was to give everybody the introduction and understanding the importance of the trend of the given name that you're trading, right? Understanding that context before you just go in and say, oh, I see a hammer, let's slap it long, right? Oh, I see a bullish engulfing, let's slap it long. That's it. If it was that simple, everybody would do it, right? And if it was that simple, institutions would adjust their strategy immediately to not allow that to happen, right? Because you have to remember, every trade that you take, somebody else is on the other side of it. And if somebody else on the other side is realizing every time they try to short a hammer, they lose, well, they'd probably stop doing that, right? But of course, it's not that simple. So that was the other piece of the candlesticks lecture. Is this ringing some bells? Any other clarification that I could provide before we move on to tonight's discussion? I can't believe it's already 6:30. I literally don't know where the time goes. I heard someone call this a phantom candle, like what happened after hours on SPY last night. Let's take a look at that while we wait for any other questions. So SPY last night. Yeah. So people call these sorts of bars a lot of different things. I'll tell you, first and foremost, this bar in itself is not necessarily tradable. In general, it can be a little bit unclear on what these sorts of wicks can represent, but the typical explanation for them is a large prearranged trade that was facilitated at this price. So for example, if an institution pre-organizes a share purchase or share sale with another institution, they might say, okay, we're going to sell you X amount of shares, in this case, probably around 2 million shares at 621.72, right? For whatever reason. For me, there's no immediate trade to be made off of these bars. However, something that I like to do is just mark that level, especially if it comes with a lot of volume as well, because that is where you can start to see some more interesting behaviors. So in this case, we haven't revisited this level yet, but if we look, I'm sure there's another one that's happened recently. So let's see if there's anything I can find. Yeah, for example, we got a block of them right around here. All right, so check this out. If we just mark that level, notice how price behaved when we revisited it, right? Ultimately, it was kind of the after hours low as well, but definitely some interesting behavior as we revisited this during the real-time trading, right? Or excuse me, global open. We could see this level acted as support just a little bit, broke below it, kind of tried to reclaim it, and ultimately fell back below and led to lows. So anyway, for me, it's not about making a trade off of this individual bar, but rather I like to mark these levels and look back later to see the reaction on them, if any, and then trade based off of that. But it's an interesting question. Any other candlesticks related questions before we roll into indicators? Yeah, you're welcome, ZT. It's a good question. Cool. All right. Well, if there's nothing else, let's get into indicators. So, as I mentioned, the content for the indicators portion of tonight will probably be a little bit thinner than the market structure and candlesticks piece, just because, in my opinion, there's a little bit less to talk about. We can get really deep into the nitty gritty for sure, and we'll talk about some kind of more unique indicators. But for the most part, I want to focus this conversation on some systems or groups of indicators. So, starting with the basics, well, kind of basics. Indicators in general can be used to assist traders in interpreting the trend, the direction of that trend, the strength of that trend, and they can also be used to help interpreting volume. And just like anything, these are always going to be used best in combination with price action. The one most important thing to note is a lot of people like to look for some kind of silver bullet in an indicator. They like to look for the one indicator that's gonna, change the way they trade, or the one indicator that's gonna tell them exactly where to buy and exactly where to sell, and it's gonna be perfect and it's gonna work 100% of the time. The one thing that I'll just mention now while we're on the subject is that there's no indicator that's going to 100% accurately tell you where to buy and tell you where to sell every single time. It just doesn't exist. And building on top of that, any algorithm that somebody sells to consumers that tells you where to buy and sell also will not be very good, right? The reason that this is always going to be true is if somebody had an algorithm that was so good that tells them exactly where they need to buy and where they need to sell very reliably, they would never sell it to you, right? Because if they sell it to you, then that code becomes public, and then all of a sudden people can reverse engineer that and trade against them, and it's easy, right? So the highest quality algorithms that actually work and indicators aren't publicly available, right? These are things that are developed by high level computer scientists and mathematicians at trading firms, and it's just not something that people like you and I are really ever going to have access to. So throw the idea out the window that you're going to have, some silver bullet indicator that's going to tell you exactly what you need to do. It just doesn't happen, right? The advantage that you have as an individual trader comes a lot from your ability to be able to be in a position and out of position very rapidly, right? A lot of big funds can't just get a large position very quickly because it would influence the market. But people like us, we could buy a full position because maybe our full position is 5, 10, 15K. So it's pretty easy to do that pretty quickly. So anyway, what I wanted to do to start off this section on indicators was to pull up a couple examples of some combinations of indicators that our analysts use at Only Options Trades. And then we're going to move to the charts and talk about a couple more examples of different combinations as well. And the intent of this section isn't necessarily to show you that one way is better than the other, but rather just expose you to the idea of these types of systems and hopefully prompt you to start exploring some of these of your own, what works for you, and maybe better understand some of the charts that you see posted in the Discord. So I'm going to start off with this chart posted by Tilio. And what we see on screen here is his pretty kind of default configuration of indicators. So to start off, he's got a unique set of moving averages that we'll get into a little bit later on the chart. But what I really want to focus on is his two oscillators down here at the bottom, which he likes to use the Stokes low and the MACD, which again, well, I'll give a quick introduction, but it's not a super beginners focused lecture, so I'm going to try and stray away from that. In general, these are two oscillators that help you identify favorable buying or favorable selling opportunities. So we'll start with the MACD because it's a little bit simpler. This one's real basic, right? When this histogram at the bottom shows green, that generally indicates that the trend is up. And when this histogram at the bottom shows red, that generally indicates that the trend is down. And with the MACD, there's a couple kind of more unique things that you can start to look for. Some things to pay attention to are when the MACD crosses to either the upside or the downside. That could signal a reversal in trend. So this blue line is a faster reacting average than this tan line. So when that blue line crosses above that tan line, that's going to be a bullish cross in the MACD. And when it crosses below that tan line, that's going to be a bearish cross in the MACD. So that's the first piece. The second piece is going to be the Stokes slope. And this one is, in terms of complexity, a little bit higher in terms of what's going on in the back end. So I'll stray away from that a little bit, but just focusing on how to analyze it in specific. This specific indicator works similar to the MACD in the sense that there's a slower period or more reactive average, and there's also a longer period or slower reacting average. So the red line is going to be our quicker, I'll say moving average, even though that's not really what it is. And the pink line, which is going to be our longer period or slower moving average. And you can see that this red and pink line kind of oscillate, right? So they kind of move higher and lower, and they're a little bit more volatile than the MACD, right? You can see how they kind of reach the extremes of their range much more often than the MACD does. However, the Stokes slope works very similarly to the MACD. In the case where we see the red line crossing above the pink line, that's going to be a more bullish cross. And in this specific chart, we see a couple kind of interesting things. And obviously this is Tilio's chart. So what I'll do is I'll just take a screenshot of this and we can annotate it together and work through it. So let's just talk through this example. Let's get on here. So the interesting piece to me here is this section of the chart right here, right? This specific area, and this line looks terrible. So let's make this look a little bit better. Come on. There we go. All right. So the most interesting piece of the chart to me is right here. So you'll notice, first of all, that this name BMY is sitting kind of right at this previous low, right in this area. Additionally, as it reaches this low, we have two kind of interesting things that are occurring in both the Stokes low and the MACD, right? This MACD, right when we're getting close to those lows, begins to cross to the upside. And same thing with the Stokes low. As we hit those lows, this also begins crossing to the upside. And this is one of the most kind of textbook way to analyze indicators, in my opinion, right? You use them as confluence. They're not your only signal, but they're something that helps give you a little bit more confidence in the trade that you might take. And in the case of this specific example, you have what you might consider, maybe a double bottom at this level of support, which also happens to be a pretty key level of prior support as well. If we drag that to the left a little bit, we also have higher highs and higher lows that have been recently formed as well. So we set our first higher high here and also set a higher low here compared to this previous high. So we have kind of just two things working out for us from a price action standpoint. We also have upwards trending moving averages, right? So our, I believe this is the 50 moving average is now trending above the 200 moving average. So again, that's what 3 or 4 kind of bullish things outside of our indicators that are giving us a little bit more confluence as to why this might be a bit of a more positive opportunity here. And again, finally, both of our indicators are crossing to the upside at the exact same time, right? Which to me helps give us just that last bit of confidence that that second low, right around the level that we drew there, is a high quality entry, right? This is an optimal use case of indicators. It's not something that is the sole reason that you're getting it in the trade. However, it's a nice kind of added piece of confidence, right? It's an added reason why you will likely be correct on a given trade. Because that's all we can do in the market, right? All we can do is find probabilities or find reasons that we have a better chance at being right. Because we're never going to be right 100% of the time, but all we can do is find some additional reasons as to why we may have a bit better of a chance at being correct on any given trade. So anyway, that's mostly what I wanted to cover on the first example. Again, since it's not a beginner lecture, I didn't want to focus too much on the details of what each indicator means, but I'll open it up for questions. What are you guys' thoughts with this example? Rob's isn't here tonight to call me out for drinking water, so that helps a lot. It's been tough not being able to get away with that.
Hey, I was just kind of like, because I've been doing a lot of trading with GE lately, and I was trying to
Mhm.
pull up on my Webull those indicators, kind of see. You said when the blue crosses over the tan, that's when we're getting bullish, or vice versa.
Correct. Correct. Yeah. If you're on Webull, it might be a little bit different in terms of the colors. So don't let that kind of spook you. Um, yeah. Are the colors different on Webull?
I think so.
Okay.
Because it's got the MACD and the signal thing, you know. Um,
Honestly, I don't. I'd have to probably see it. If you want, you can post a screenshot in the chat and I could kind of I could probably decode it a little bit, but you might be able to see it visually as well, Nick. Whichever line is more reactive, that's going to be the shorter term MACD line. So that's going to be kind of the one you want to see cross above or below the other line.
okay. Let me just post my whole little chart here. Give me
All
just a
right, cool.
second.
Yeah. Yeah, do that.
Appreciate
We can take a look at it together. Yeah, of course. Amani says, how do I feel about RSI? To me, the RSI isn't something that I give too much weight to. The problem is, like, for example, if we open up RSI on this on the S&P, um, RSI has been oversold for the last overbought for basically the last month with absolutely no reversal, which, is great and all. And really all this indicates is just a sign of strength. But to me, I don't need to see that, right? Like the RSI being over 70 doesn't help me understand that the market's strong, right? I can look at price action and tell you the fact that we have 5 green days with all these gaps being left behind. That's a clear indication of strength, right? So for me, the RSI just doesn't hold much water. All right, let's look at Nick's example here. Okay, so that's funny, Nick. Yeah, for you, the MACD's opposite. The blue line is the slow line, and the orange line is the faster line.
Okay.
So, and the reason I was able to figure that out, Nick, is because of the histogram in the background. So we can see when the histogram is green, the orange is above the blue, and when the histogram is red, the orange is below the blue. So that's
Gotcha.
basically how I was able
Okay.
to figure it out.
Yeah, that makes more sense. All right, cool. Thanks.
Yep, you got it. That's super confusing. It's funny that it's literally the exact opposite.
Yeah, I appreciate you.
Yep, good question. All right, ZT, never heard of Stoke Slow. Can it be used on the slower time frames or is high time frames preferred? That's an excellent question. I'll give a blanket statement in saying that in general, any indicator can be used on any time frame. For me personally, the person that I learned how to use the Stoke Slow from was from Tilio, and again, this is all anecdotal experience that I'm relaying here. I've never seen him use it on anything other than the daily. So take that as you wish. Yeah, I'll leave that as the answer. You never use indicators besides EMA, volume, and VWAP. Is that bad? That is absolutely not bad, Maxwell. There's absolutely zero requirement that you use indicators in the market, right? It really comes down to how you like to trade and what you find is the most useful for you. I'll tell you, for me at this day and age, I don't really use indicators nearly as much. I use very similar indicators to you. I'm focused on volume and I'm focused on moving averages, and that's basically it. All other things to me just aren't that relevant. However, that doesn't mean that I'm the one that has the gold standard on indicators use. No, you are not weird at all, Maxwell. Tito asks, do I like to draw fibs? I do, and we got one on the SPY right now that I drew up at 650-ish. Yeah, absolutely like to draw fibs. I think they're a real important part of understanding future resistance levels, especially when we're in a market like we are, when a lot of things are trading at or above all-time highs, or previous all-time highs. You like to get in a trade once the price action is taking a breather or touching the EMAs. What indicators or what would I advise to look at when the trend is so strong it doesn't breathe, like the move in SPY today's morning? Yeah, so I think you basically answered the question yourself without realizing it, Brian. If we take a look at the 9 and 21 EMAs from this morning, you're absolutely right. There was basically no real pullback to the EMAs all morning. If you are the type of trader that like to see a pullback to the EMAs before you enter, and you're not getting a pullback to the EMAs before you enter, it sounds like it's not an environment for you to be taking the trade, right? You don't have to be trading in every environment. You don't have to be catching every move. I will generally say, right, this is a pretty good example of a breakout, right? These sorts of breakout trends that we took a look at in our prior example here, right? A breakout, you're not going to get much opportunities to enter in a breakout, right? The reason being is because people are taking advantage of the high probabilities of a breakout, right? Once we're in kind of that breakout mode, there's a real high probability that the trend continues. And we could see that here, right? Once we begin to break these, and I'll zoom in a little bit so you can all see a bit clearer. Once we break these lows of day right around here and kind of retest them, there was basically no looking back. There was no real pullback at all until we finally put in a bottom, right? And this is a great textbook example of a breakout, or in this case, a breakdown, which also came after what looks like a failed break out or a failed break to the upside in the first place, where we tried to get back above some of these pre-market levels and ultimately failed. So again, Brian, kind of two answers to your question. The first one is, if you really like to trade when you get a pullback to the EMAs and you don't get a pullback to the EMAs, it sounds like you don't have a trade then. So you just don't trade. You sit on your hands and you wait, right? You wait for your trade to come to you. The second answer is, if you're trying to change your system to catch moves like this, you have to understand that breakouts aren't going to give you a nice clean opportunity for you to get in, right? That's just the nature of a breakout. They're a very strong move. They're very aggressive. There's a lot of people who are getting involved in breakout trades. That's why we typically see that above average volume during them. So you'll have to take a little bit more of a risk and buy maybe a more minor pullback, like something like this. Again, the problem with trading breakouts like this is that your stop has to be pretty loose. Like, for example, if you're getting short here, realistically, your stop needs to be above these highs. You could make it a little tighter and make it above here. But anyway, your risk is pretty high. Whereas if you're buying a pullback to the EMAs, which today wasn't much of a trending day, but if you were to buy a pullback to the EMAs, say here, for example, your stop's a lot more well-defined, right? Because you're in a little bit more of a trending environment. So you could stop maybe at those lows there, or maybe below the bar that you entered. So you have a couple more options. Amani says, why do I see people use the 9 EMA a lot? Why that setting? Amani, that is an excellent question. It's one that I don't really have the answer to be completely frank and honest with you. I don't fully know what the origin of, the 9, 10, 20 EMAs, why that's what people like to use. With that said, 9 EMA and 21 EMA, or the 10 EMA and 20 EMA, are really, they're staples of EMAs in general. Those are some of the most commonly used exponential moving averages. But I don't specifically know who decided that was going to be what the case is. But I will say they're certainly very effective. In general, I could give a little bit of reasoning behind it. The 9 is a moving average that's not too reactive, but in general follows price pretty closely. So it helps traders better understand short-term price movements as opposed to something, maybe a bit longer period. But outside of that, I don't 100% know, why the 9 and not the 8 or the 11. Not 100% certain. And people have their own verifications. But anyway. Could Emily on NVIDIA. We're not looking at charts right now, Emily, but if we have a little bit of time at the end, we'll certainly take a look at NVIDIA. That's the first thing we'll look at. Could I draw a fib for someone who doesn't know how? Sure, Tito. Yeah, let's take a look at a fib real quick. So let's go to a clean set real quick. We'll draw a fib. So let's clean this all up. So in general, kind of two ways to draw a fib when you're in an uptrend or when you're in a downtrend. I'll start by drawing a fib on this retracement here. So selecting the fib, I just select the fib retracement here, Fibonacci retracement. You start at the highs and you end at the lows. And for me, my fibs, I hit a lot of stuff by default. So let me just kind of re-show that so you can see how all that works. So in general, this is how the fib works, right? It's pretty simple. You really just need to focus on swing highs and swing lows. If we were in a, let's say when we're in like an uptrend, I guess we can go low to high. Oops, that's not what I thought I wanted to do. Go like this. So if we were in an uptrend and we were trying to better understand, the capabilities of a name on a pullback, we could draw fibs like this, but I don't personally do that. Do I ever use the VWAP deviations? They're ugly on the chart. I don't use the VWAP deviations. Which are the golden zones? I believe, again, I'm not the most avid user of the golden zones, but I believe the golden zone is typically between the 61.8 and 78.6 right here. But I don't actually know for certain. That would be probably a good one to just double check me on with like a Google search or something. But again, the golden zone isn't something I trade too often.
Hey, so just to confirm that, the starting point when you're drawing your fib is going to be the 100%.
So the answer is yes. The 100% is always where the fib starts.
Yep.
However, if you started I guess the choice is really if you start from drawing from the highs to the lows, or if you start from drawing from lows to highs. So long story short, when you're in a downtrend, highs to lows. When you're in an uptrend, lows to highs. If that makes sense.
Yep.
Cool. But yes, wherever you click first will be the 100%. And it's a little confusing because I have that hidden by default. Cool. All right. Do I prefer using fib higher time frames? Yeah, absolutely. I mean, you can see it already. I have it. Oh no, I made all these levels on my normal thing. Let me clear that out real quick. Yeah, you can see here, I already have the fibs going on this chart by default. So yeah, I'm typically using them on daily time frame personally. However, obviously, just like any key level, obviously it's still going to matter on the lower time frames. However, I'm drawing it from the higher time frames. If that makes sense. All right, we got one more indicator example that I wanted to get through. So let's take a look at this one. So this is a chart from River, and again, just another example of the different types of indicators that you could kind of use in combination. So this one is a lot different than what we saw previously. So in Tilio's example, we are a little bit more focused on the oscillators, where in this specific example, it's a lot different. So River here has, first of all, just to kind of break this down a little bit, he has an indicator that automatically plots the opening range, which it's not something that I'm going to explain in too much detail because he would just explain it far better than me anyway. But again, custom indicator for some things that he looks for in his strategy. The next thing to kind of pay attention to is this stepping average here. This is actually a moving average from a higher time frame, which is being plotted on a lower time frame. And let me show you how that works really quick because that's a more interesting concept. So I'm going to pull up the 5-minute of the SPY on the left here, and let's pull up the hourly of the SPY on the right. Let's do that. Boom, boom, boom. Make it blue so it's more clear which is which. So blue one's going to be on the right. So on the right, I'm going to go ahead and just add a simple moving average, just a simple 20 moving average. So let's go ahead and do that. And let's make it yellow so we can see that clearly. All right, so we just have a simple 20 moving average on the right chart there. And on the left chart, I'm going to do something a little differently. So there's this study called a multi-time frame moving average. And if I go and put this as a simple moving average from the 1 hour and make it to 20 and make it look the same as we did before, now we can see that exact same moving average from the hourly now plotted on the 5-minute. So if we look this first hourly bar of the day, you can see what the value of the moving average was up here. First hourly bar of the day, the moving average was at 631.99, which we can see here, it's plotting right around that level. And towards the end of the day, it was at 631.1. And if we look here, right around here, it's right there at 631.1. So this can be pretty cool because here you can use your moving average from the higher time frames as really easy, quick reference points on the lower time frames. So if you have moving averages that you know are real important from the daily or higher time frames, and you want to be able to focus them really easily on your lower time frames, you can do that with this specific indicator. And if I change this, so if we go from exponential, let's do the daily, and let's just toss the 9 on here, and we'll get rid of our other indicator because now you know how it works. Now we can see that daily 9 EMA just as a level of support on our chart that's just plotted by default. So it's really cool how this works. I really like it. And you can see exactly how prices reacted around these levels previously. There definitely is some significance. The one thing to note is, obviously, the daily moving averages are plotted off of a lot longer period of time. So you shouldn't necessarily expect, immediate reactions off these moving averages. However, I do find it pretty cool, like here, for example, how clearly price is respecting this daily 9 EMA. So I find this to be a really nice part of a more advanced, indicator system. But again, just a tool, and you don't necessarily need something like this. But I do find it very fascinating and nice to use. Oh, damn it. Didn't mean to click that. Okay, and then the last thing I'll show is just in general in Thinkorswim, there's so much flexibility that is offered in terms of the custom indicators that can be used. This is a set that I got from Assassin a long time ago. I never really used it, honestly. I just kind of like to show it off because it is so wild. This is some algo that he made, God knows how long. And this just shows you how crazy you could get with stuff. This was something I don't even really know how it works, but it's like a combination of a volume study with these oscillators, and it plots these buy and sell things. It's wild how deep and into the nitty gritty you can get with some of this stuff. There's a couple more that I've found that I've really liked in the past. Let's see if I could pull those up real quick. Let's see, which one is this one? I don't even know. This is opening range study here that just plots that. Oh man, there's so many cool ones that I've had in the past, but I just don't remember where they all are. Let's see. Yeah, this is one that just plots pre-market high and pre-market low automatically, adds that multi-time frame moving average. So anyway, long story short, especially on Thinkorswim, there's so much stuff that it is capable of. So once you start to kind of find some signals that you're interested in and some indicators that you're finding some success with, you can really start to get into things, especially now that AI can, basically code things for us in some ways. And coding an indicator isn't a big deal because you don't really need to maintain it as heavily. So I'm sure you could leverage AI pretty heavily to make you some really cool stuff in this day and age. So anyway, just kind of want to show you how crazy things can really get. Yeah, Monty, that's an excellent question. Let's do that. Yeah, and I think that's kind of how I wanted to end off today's class. So obviously we can't go through every combination of indicators and show you how to enter every single type of trade with infinite number of indicators. But let's talk about one, and I'm going to go with Tilio's study set of indicators. And again, obviously you have the benefit of hindsight to aid us here. So that makes things a little bit different. But let's talk a little bit about this recent price action in the SPY and how Tilio's indicators have been kind of behaving. Now, I'm calling them Tilio's indicators, but it's not like he owns them or anything. It's just he's the one who taught me how to use them. So anyway. All right. So taking a peek, that is a completely fair point, Scotty. I don't disagree with your point. Scotty says he doesn't want to trust public AI to code something that can lose him money. Yeah, I think that is an incredibly important note. Yeah, absolutely. Never blindly trust anything, especially AI. Okay, so looking at Tilio's example, or excuse me, these indicators in specific, recent price action in the SPY, If we take a look, this was the prior high right around the 613 area. And ever since we broke this prior high, this MACD has been diverging to the downside. And what that means is as price is making higher highs, as we can see based on the price action, the MACD is making lower highs, which again isn't necessarily something to, raise the alarm about or freak out about immediately, but it's just something to be mindful of, right? It's just something to kind of be considering. The one thing I also want to note is that if you look at the MACD here, it was trending basically down through this entire period while the market continued higher. And same thing here, it was trending down through this entire period and the market trended higher. So there's no real, that's why it's so important to not just pay attention to indicators. All right. So focusing on more recent price action, what I first want to mention is this increase in, oops. Oh man, I'm blowing it. Zoom back in. All right, let's try that again. All right, so what I first want to mention is this increase in selling volume, right? If you guys notice, we haven't had really this trend up in selling volume ever since we bottomed out. Selling volume, we've had maybe one or two above average days, but no continuous increase in selling pressure, which is something that we saw here. Also, this was one of the first kind of bear bars closing near its lows that we got off of the highs. We haven't seen a candle like this at all in this uptrend, right? If you look at prior pullbacks, we maybe saw this bear bar closing near its lows, but it wasn't below the lows of any prior bars. This one in specific set a new high, then closed near its lows, which based on our recap from candlesticks, that's not going to be a positive sign, right? So that's kind of a warning sign for us to begin starting to maybe not necessarily look short, but be a little bit concerned for some downside. Next up, we have our indicators both trending to the downside. So Stokes low is open to the downside. MACD is open to the downside and trending. The only thing to note again is that the crosses to the downside took place a couple days before, right? And you could see there's been plenty of crosses to the downside previously that weren't super successful. And I think that's the most important thing to highlight here is indicators alone can be pretty dumb, right? If you just look at the Stokes low, you probably would have shorted here and here and here and here and here, which all in general would have been really bad ideas, right? You wouldn't have really made money at all. You would have just got blown out. So trusting indicators blindly is never going to be the way to go. So now that we've kind of set the stage a little bit better, in recent price action, again, we set a new high, then had a bear bar closing near its low. Not going to be a bullish signal basically ever. We also have both of our indicators open to the downside and trending in a bearish direction, rising volume to the bear side, which gives us a little bit more confidence to be trading on the short side. Now, again, in any uptrend, when you're trading against the trend, you always got to be cautious. So in no way would these indicators for me let me want to go short, at least for a swing trade. However, it would help set my bias a little bit, especially when we have kind of price action like this. And then we gap down the next day. If I'm a day trader, right, after we see a day like this, then we gap down, all of the indicators on our higher time frames are trending to the downside. I'm going to be looking to trade to the short side on this day, right? And again, looking at our indicators, we came into the support this day. So with hindsight to our benefit, maybe not the best place to get short. But for me, there hasn't been any super meaningful trend changes recently. So all I would use this specific set of indicators for is just setting my intraday bias, right? Because the trend is still fundamentally up. And until that changes, there's not too much we could do from an indicator standpoint looking for a reversal because we got to be paying attention to price first. Does that help a little bit, Amani? Again, also, I will preface any further statements by saying these two indicators are not something that I'm personally using on a day-to-day basis. Hopefully my explanation alone helps it make that a little bit clear. In my opinion, they're not that powerful, right? It's important to know that they exist, and there's certainly people who use these like religion, but for me, they're not that powerful, right? There's a reason that I have a whole lecture dedicated to moving average systems, because that is where the true power lies, in my personal opinion, and the opinion of traders who are far more skilled than myself. So yeah, I got plenty of time. Amani, what do you got? What's your last question? Do you believe price chases liquidity? It's a fascinating question. I've never been asked that before. I think to an extent, the answer is yes, because fundamentally, for large institutions to enter and exit positions, they have to be trading in areas where liquidity exists. So I think I do believe that. I think I do. Yeah, thanks for being here, Tito. I appreciate it. Yeah, Money, I think the answer is I do believe that price chases liquidity. Now, is that like a something that I'm religiously paying attention to as I'm trading? No. At least not directly. I think implicitly it's always a consideration, but it's, I guess, not something that I personally am specifically looking for. Yeah, that was a very, very interesting question. That was something I've never been asked before and never really thought of that directly. So very interesting. Thanks for being here, Aaron. All right, with that, let's kind of summarize what we talked about today. And can you find more about moving average systems in my tab? In general, yes, but I don't know if my tab is visible anymore. I think right now it's private. Okay, so today we reviewed the fundamentals of indicators. So we talked a little bit about some warnings and reasons why it really shouldn't be trusted on their own. And then we talked about a couple different applications of indicator systems and some real world scenarios. Again, I'm certainly looking forward to lecture 8. In my opinion, that's the indicator lecture that I wanted to give tonight because I just think the moving averages are the best indicators and also volume. But anyway, I'm refraining from covering that tonight because, yeah, we have a whole lecture dedicated to it, and I know we're going to do it justice then. So I'm going to wait for that time. Cool, everybody. Well, that's going to do it for tonight. I appreciate everybody's time. Next lecture should be next Tuesday, but I'm also going to be traveling next week as well, so that might introduce some complications. But hopefully I'll be a little bit more on top of it in terms of scheduling this time around so we can make sure nothing changes last minute. But anyway, appreciate you guys' time tonight as always. So Maxwell says, whenever you're scalping on SPY, you're marking highs and lows as you go to find new support and resistance. I think, Maxwell, the answer to your question is no. I wouldn't personally use the indicators that we talked about today to determine when not to sell. I'm always going to be more focused on price action to help me make that specific judgment call. All right, everybody. I appreciate it. Maxwell, if you want to continue the conversation too, feel free to shoot me a DM. Happy to continue talking too. All right, everybody. Thanks so much for your time. I'll see you guys in the next one, and I hope you have a great rest of your evening. Adios.